We also have what's called a satellite portfolio because many people also have money outside of these sort of not very flexible plans, because many of my clients seem to have lots of plans because they worked at different places.
Sure. So they have IRA rollover or something like that.
Yes. And so they have money stuck in one place and they have money stuck in other places. Mm-hmm. And so for the core is like the basic stuff you really ought to have. Mm-hmm. And the satellite where we branch out, because the core covers the 4 core asset classes. Right? Mm-hmm. And the satellite portfolios, now we move out to IWM, EEM, TLT, IYR, IYM, and GLD. And what we do is we've got basic materials, we've got real estate, mm-hmm. we've got the emerging markets international, we've got long bonds, we've got gold. And so it's a further diversification from the core portfolio. Right. And so you can see here the percentages are listed, and we calculate this every week.
Now how do you approach these in terms of choice? And I noticed maybe you're doing some hedging against them. Continue on, please.
Well, what we do is, like, instead of buy and hold, I think we can describe what we do, and we'll talk about buy and hold later, as diversify, hedge, and bail. Okay? So for my own portfolio, what I do is I jam all of these things together, and I manage them, and I monitor them. And once they're down, there's a certain magic number, because your losses are asymmetrical, right? Mm-hmm. Because say if you have a 50% loss, you need to make 100% just to get back to where you came from. And so the magic number is around 9.5, that then you have to make 10 to get back even, which is, within the normal parameters of the market's fluctuation. Sure. So each person has to monitor their own portfolio. And if it gets to this minus 9.5 magic area, then I wrote a few articles. There's some crude hedging that can be done using those inverse funds, sure. inverse ETFs. And for my own portfolio and for the fund that I use, it's considerably easier for us to use futures to hedge. And we're just much more dynamic there, right?
Sure, yeah, absolutely.
It's not practical for most people to be sitting there in front of the screen and hedging with all this futures and stuff.
Right, and besides, if they have IRA accounts or something like that, they can't do that anyway or use options, but they can use the inverse issue.
Exactly, so we provide the information to the members.
You're not using the leveraged issue, you're using just the straight inverse issue, I assume.
Right, yeah, I wrote an article at the website for the members that basically show them how to calculate how many shares they should have, but I can't remember off the top of my head exactly what I said. I have to go back and read it.
That's all right.
And then, so we got the diversify and we've got the hedge. And then there's the bail part. Now, there are every so many years or whatever, the market actually has a major event. Mm-hmm. And we can monitor that by the volatility index, and you can monitor all sorts of proxies for volatility, like range, standard deviation, and such. Sure. And then there's good old-fashioned, been there, done it, been in the trenches, the whole thing's going to go up in smoke. And it was pretty obvious last September when Congress was about to vote down the first bailout that the market was going to go nuclear. And so on a Wednesday night, I duly wrote to all the members and says, I think this thing's going to go nuclear, so you better take a look, because if you can't hedge and if you can't do whatever, then exit stage left and step aside.
That's the bail.
That's the bail. And you have to step in because you just know this thing's going to blow, right? Okay, and then last thing is, because we measure a bunch of factors and then we decide how to allocate. And this last chart here shows you what we've been doing with this satellite portfolio. You can see that the position here, even if you just look at the bonds, we tend to own the most bonds when the market is at its worst moments, like when stocks are at the lowest, and when things recover a little bit, we scale down. And so you can see here, we have gold in our satellite portfolio as a proxy for the currencies. Not because we like gold, not because we like commodities, but because gold is basically a proxy currency now. And you can see how that starts to move when it should be, and so on. And so there's an interplay, and there is quite a bit of difference in what a person could be holding from month to month. And the satellite portfolio is rebalanced once a week.
Once a week. That's active.
Yeah. Well, that's active, but there are a lot of times when there's been a lot of studies that show if you're off by a little bit, it's not material. Mm-hmm. Or because if 1 week it moves from 17 to 18, it's not really material. But there will be a week where it goes from 20 to 15, then you should do it. Yeah. And so you can skip weeks weeks. And also, if you're contributing new money, you can keep the cash and top up what you should own more of.
Sure.
And that's another way of also allocating with less cost. And of course, it goes without saying, you should look for an investment firm that charges you as little as possible.
Yeah. Now, is this a part of the tactical allocation that you featured?
Yes. So the strategic is you decide which asset classes you like to own, and we do our tactical allocation by crunching numbers based on risk.
You've been talking a lot to me about the death of buy and hold.
Oh, yes.
And let's talk about that. Tell me how you feel about that. I have my own feelings about it and agree that it has been dead now.
It's good and dead. Remember now what a difference 1 week makes, right?
Yeah.
Remember last Friday, everyone was saying it's over, and the skinny lady was just belting it out, right?
Yeah.
And buy and hold is dead, and I've got here quite a few articles. Battered stocks put blue chip label in doubt. Mm-hmm. An end to buy and hold stock investing, and even rebalance your portfolio can be a tough ride. And so when you're an investor and you hear this, you're like, what? Because it's such a great slogan to say buy and hold is dead. But the question is, what does buy and hold mean? Are there actually people who are buying and holding? And if so, what are they buying and holding, right? But what they really mean is buying and holding stocks is dead.
Yeah.
Because I notice nobody actually rebalances anyway. So my thesis is this, that people run around, they pick a few stocks that they love. They marry them and it's forever. Well, buy and hold for commodity stocks didn't pan out. It never worked for internet stocks. It never worked for anything, right? Mm-hmm. Didn't even work for the people who bought gold in 1980. So are there really people who buy and hold?
Yeah. What they do is they buy and hold mutual funds or something like that.
Right. But the thing is, the managers of those mutual funds, they're not sitting there twiddling their thumbs, are they? They're active managers. They're doing their research. They're doing this, that, the other thing. But guess what? Their performance is highly correlated with the S&P because most of them are what's called closet indexers.
Right.
And so you're paying a lot of extra funds for a guy who says he's like a super fund picker. I mean, if you look at Contra Fund or the Legg Mason Value Trust or the all these growth funds and so on, they've all done terribly and really bad. But you paid them along the way. So basically, a lot of mutual funds are closet indexers, and then there's only several ways to outperform, right? Yeah. The manager has to be really good at picking the next hot market. Good luck drawing straws. The manager places a big bet in one sector and gets really lucky, and we saw that in a lot of the commodity funds. Or you do defensive diversification, which isn't the mandate of those funds, right?
Right.
So basically, if you want to do well, you can just construct your own portfolio using ETFs, and then you can follow a proper plan because it's not that difficult. I mean, for example, the poster boy for this defensive diversification is David Swenson, and he's the chief investment officer of the Yale Endowment Fund. Mm-hmm. And he explains in several articles that we have here that he says here, asset allocation is the tool that you use to determine the risk and return characteristics of your portfolio. It's overwhelmingly important in terms of the results you achieve. In fact, studies show that asset allocation is responsible for more than 100% of the positive returns generated by investors. So most people start with this top-down, or is it bottoms-up, by picking stocks, but they forget they have to own something other than stocks because when things don't go well for the stock market, it becomes a problem. Yeah. But I think I've detected something weird about investors.
Yes.
They have really, really bad fear of bonds. Say, for example, if we had started on December 31st, 2007 with this 60-40 portfolio, 40% of your money in the S&P 500 and 60% in the Barclays 20-plus year Treasury Bond Fund, which is TLT, well, your $100,000 would have been split into $40,000 into SPY and $60,000 into TLT. At the end of the year, December 31st, 2008, say you only rebalance once a year, your SPY would have gone from $40,000 to $24,687, right, which reflects the full haircut. Right. But the long bonds had moved up in value to $76,966, and at the end of the year, your portfolio would have been $101,654.67, and that's not even including dividends. Now, as far as I know, every bank that I walk into tells you to do, or at least used to tell you to do 60-40, right?
The other way,
yeah,
60 spiders.
60 bond. But what they've done in the last few years is everybody's chasing emerging markets, commodities, gold, frontier markets. And whatever we do, we cannot buy any treasury bonds whatsoever.